Welcome, everybody. Thank you for your patience. You are listening to the Independent Solutions 2019 fourth quarter economic update and market commentary. We'll go ahead and get started. I appreciate your patience, and thank you for joining us today. I'm your host, Glenn Wiggle. I'm a founding partner at Independent Solutions Wealth Management, as well as the Chief Compliance Officer. On the call today, we're going to be joined by another partner at Independent Solutions, Dan Niemann. Dan is our Chief Investment Officer, 20 years in the industry, and leads our investment committee, which has over 170 years of investment experience. We're also going to be talking to John Thur. John is a 40-year veteran of the industry, also a chartered financial analyst, and has been with the firm for many, many years now, a very important part of our investment committee as well. And then finally, we'll be talking to Paul Meeks, and also a chartered financial analyst, and Paul is known best as being really a tech guru on Wall Street, on CNBC on a frequent basis. So we'll be talking and going down. Before we get there, I wanted to just kind of go through a couple of housekeeping things, if at all possible. Number one, everybody is in a listen-only mode. We're going to really try to keep this call, as we usually do, right to a half an hour, just 30 minutes, so that everybody can get back to their busy business day. And so with only 30 minutes, it's difficult oftentimes for us to obviously take phone calls and questions. We have over 100 people on this call, so we want to make sure we get through all the information that we want. But the replay will be available, so if you do need to step away or you want to go back and listen to anything that we talked about, or maybe replay something that maybe you missed, you can always go to our website at iswealthmanagement.com, and you can find the replay available there. So why don't we jump right in, and we'll start off with you, Dan. As our Chief Investment Officer, you leading our committee and really doing a wonderful job on guiding us through both good markets and bad. It's been some pretty good markets. I thought we would talk about where we're at with our portfolios, where we're at with the markets, and maybe just a little bit of an update for those of you that might have missed the third quarter call, maybe just an update on some of the changes we've made in the last several months, or maybe over the last 6 months even, to the portfolios. So Dan Niemann, Chief Investment Officer and partner at Independent Solutions, you have the floor.
Thanks, Glenn, and thanks everyone for joining us. I really appreciate the fact that we're able to do this type of call on a regular basis, and also invite our clients, on our investment committee and everyone to kind of be on the call, hear what we have to say, and hopefully take that back. Not only our reps that are bringing assets in, but also our managers and clients. Everyone kind of being on the same page. It's nice to be able to have the medium to be able to express our interests, express our concerns with the markets, and also express our goals. I think that's kind of the most important thing from our standpoint is, are we meeting your goals as clients? Are we meeting our expectations as managers? And I think from a portfolio perspective, our strategic allocation models have really done that through not only through this calendar year, but in the past, 5 to 10 years, as the markets had this incredible bull run. We've taken risk off the table. We've kept our returns in line with composite indexes, whether it be an aggressive model or a very conservative model. We've stayed the course, and I think that's the most important thing when it comes to investing over the long term. That's our goal, is to put our clients' money in for the long term in most cases, and those that have a short-term bucket, keep up with the short-term indexes as well, and not try to make promises that we can't keep. And I think we've done that. So returns in our strategic mutual fund and ETF models for the past, calendar year or the year-to-date returns have been in line with indexes, with about a third less risk, which is huge. We've been able to have quality managers or quality allocation into the right asset classes. We haven't done a lot of changes over the past year. In our rotation ETF model, we've kept quite a bit of cash. We've been at 15% cash most of the year, which is fairly defensive, but yet performance is in line. And we feel that the risk we're taking off the table helps our clients, in the long run, should we put that cash to work. Speaking of rebalances or what we're doing in the future, we're definitely going to gear up as we approach the first of the year to take a look at all our positions and do a search to make sure that we're in the right positions, in the right mutual funds and ETFs, and then put the cash to work that's on the sidelines that we get from dividends at the end of the period here. Stock models, I know we have our investment committee on the line, and we're going to hear from everybody. Our stock models are doing great. Everything from growth to value, whether it be dividend or core holdings or tech, we've all, I think, been in line, if not better, than what we've what our comparable indexes or categories would be. And we're all on the same page. I think that each of us, as we talk every month as an investment committee, have the same ideas, the same goals, looking for quality stocks and not taking undue risk in a market that continues to go up. So with that, I get back to you, Glenn, and hopefully that's a good enough update for everyone with regards to our models.
Thanks, Dan. I should mention, by the way, I know we have some folks that are probably not clients on the call as well. This is open to the public. For those of you that are not aware or familiar with Independent Solutions, we are an investment advisory firm with $500 million in assets under management. We run about 25 different portfolio models, from mutual fund asset allocation models to ETF models to individual stock models as well for higher net worth individuals. And so our investment committee, which consists of 7 people in total, includes multiple mutual fund managers, multiple CFAs, and in total is 175 years of investment experience. And so I will go to probably one of our most senior analysts, which would be John Thur. John, you are let's see if I can unmute you here because I muted you and now I can't undo it. There we go. Sorry about that. John, I always go to you because you kind of give us 40 years in the industry, 10 years with Independent Solutions. We've seen a lot of different markets in just the last 10 years, but certainly in your 40-year career, you've been through, high interest rate environments and, the S&L crisis, the 87 crash, and so on and so forth. So I always like to start with you to kind of, give us your macro view of where we are globally in the economy, and then what your thoughts are where we are in this cycle when it comes to the U.S. markets and U.S. economy.
Okay, sure, Glenn. Thanks, everybody, for being on the call. I'll try to keep this brief, but we're looking at relatively slow economic growth around the world, but still flat in Europe and Japan, probably going toward 1.5% to 2% in the U.S. And this is for 2020. The U.S. is probably is the strongest economic environment right now, and along with the rest of North America. But where we're struggling here is we have slow economic growth projected for 2020. We have flat to low sales and earnings growth, maybe as high as on an average 6%, but I keep seeing that get ratcheted down every quarter when I look at the earnings projections and estimates. I need to see that stop going down. We had tremendous PE multiple expansion this year. What that means is prices have grown almost 26% year to date in the S&P 500, where earnings have been anywhere from negative 0.5% to maybe positive 0.5% on average. So you've seen the price grow dramatically faster than the earnings growth. So the PE multiples are close to 23 and 24 times, which is an expensive market. So in order to keep this market where it is, we need things to happen, and that is we need to see earnings start to grow faster. We need to see sales start to grow faster, and we need to see a stronger economic growth around the world. I think it's going to be difficult if we don't see this to maintain these levels in the market. But with that, I will have a caveat. We are in a market where there's a lot of quantitative models, and the quant models do not look at valuation. They mostly look at environment. And with low interest rates and the forecast for next year is they're not going to go up, primarily a high probability. When you look at full employment, when you look at positive economic growth, even if it's slow, the quant models are going to keep suggesting to buy. So this is the struggle we face, is money's going to keep going in, and we're going to start to see valuations get very stretched. So there should be a sell-off coming, but I don't think it'll last long, because once it sells off in the environment we're in, new money will come in and buy stocks that are cheaper.
Right. Thanks, John. And certainly with interest rates that's still near zero, not a lot of places to go to find returns in the market, which is another catalyst to keep money flowing into the stock market as well. Paul, exactly. John mentioned being more of a stock picker's environment. Getting away from maybe the broader indexes a bit, and that, I'm going to lead to you for this one. Paul Meeks has been on CNBC almost every week for like the last, almost 15 years, 20 years, 25 years or so. Paul is regarded as one of the foremost experts in technology and growth stocks on Wall Street, which is the reason why they continuously interview him on CNBC and Fox Business and places like that. But let's talk about where your expertise lies, Paul, and really in the technology space. And something you had said a while back in a previous call that semiconductors, which is really something that you watch very closely, oftentimes tends to be the bellwether, both leading in and out of different types of market environments. And so I thought I would start with maybe the technology sector, more specifically semiconductors, where you see us in the cycle, and then maybe talk just for a few minutes about your individual stock portfolios and how you've got those positioned, to handle volatility or opportunity that may come along via a correction.
Yes, sir. Well, thanks for allowing me to participate. I always love doing these things. One of the things I would tell folks about the tech sector, and first of all, to put the tech sector in the proper perspective within somebody's overall stock portfolio, technology and communication services, which are two of the 11 sectors that comprise the S&P 500. Tech is obvious. When you hear communication services, think of the wireless companies like AT&T and T-Mobile and Verizon, so you know that they're more telecom than tech. So right now, you put the weight of those two sectors together, they comprise about one-third of the weight of all the holdings in the S&P 500, which is a pretty good surrogate for the U.S. market. And because technology has done so well in 2019, the market itself has done really well, but the tech sector has been the best sector of the 11. So I hate to say this, Glenn, because everybody always wants to be a cheerleader for their group, but I'm telling folks right here, right now, as we position ourselves for 2020, I would, if you have more than one-third of your stock portfolio in tech and telecom, I'd actually cut it back to at least that weight and maybe even go underweight because I'm worried. Not necessarily worried about fundamentals because I don't see a recession or only about a 25% chance of a U.S. recession in 2020, but the valuations have been stretched. It's very difficult for me to find new tech ideas. Now, because tech stocks are so volatile, whenever they announce their earnings, which is usually every 90 days, quite often you'll have a stock that performs poorly after that because it did not meet Wall Street expectations that quarter for either sales or earnings. And so, yes, in any kind of environment, I occasionally find an idea. But I would say overall, I would have a portfolio that is in stocks, but no more than one-third of that portfolio in tech and telecom. And within that, I'm very comfortable with semiconductors. These are the chip companies. We have a voracious demand for chips. And so maybe I would be focused within tech in that area. But overall, Glenn, I'm essentially raising the flag for people to be worried. And I know if you hear me on television, I say the same thing. And sometimes I'm not as popular as I should be because I'm bad-mouthing my own group, but I'm just being honest.
Talk about your other portfolio for a second, Paul, the more dividend side of the because you run a couple different portfolios for independent solutions, one being, of course, a tech fund, but other being a dividend and kind of a value strategy. Talk to our listeners a little about, how that strategy might differ and how that might be a better fit, or at least, a safer play at this point, and then I'll swing it over to Dan after that.
Yeah, great question. So I do two things because I've been a tech investor for a long time. And like everybody else, I took a bad beating when the internet bubble popped in the late 90s, early 2000s. And so you have to always have a plan B. My plan B is to use my noodle to find some value in dividend-paying stocks, which I actually am more bullish on as we enter 2020 than I am in the tech portfolio or the tech strategy that I run. So what I look there is for deeply discounted to intrinsic value ideas, kind of like a Warren Buffett approach, with the adage, be greedy when others are fearful. I'm a contrarian investor. I look for stocks that have at least a 2% dividend yield. Right now my portfolio yields 4%. And even though I look for dividend payers, which are typically slow growth companies, I need to see at least 10% price appreciation from what I calculate. So I'd say it's kind of a yes, it's a value strategy, but since I am looking for stocks, they're not just collecting the coupons. I'm looking for stocks that do have at least some price appreciation potential. I think it's a good mix. I'm actually more comfortable with those names here than I am my tech strategy. Of course, occasionally I find tech stocks that I think are reasonably valued that pay dividends that can actually be in that portfolio and not just in my tech portfolio. So maybe it's a little bit of a mix.
Perfect. Thanks, Paul. Dan, back over to you just to talk about the asset allocation side of things. Obviously, I think, our analysts are worried a little bit about the valuations. We're not necessarily worried, but at least aware of where we are in the market cycle, which is, a big reason why we promote using our asset allocation portfolios as a core to your overall investment strategy. So that's why we have 25 different models, that you can invest in a strategic allocation as the core and then supplement it with the stock portfolios to give you long-term opportunities in the markets. But talk to me about what we've done in the past and how we're positioned going forward to take advantage of the market volatility and how we reduce risk for our investors so that, we are going to always have rough patches in the market. It's not something to be afraid of. It's something to be prepared for. And I think, with our investment committee, with you at the helm, I think we're very well prepared for any sort of volatility. But maybe you could talk a little about some of the things that we may do in the event of some sort of a pullback or a correction.
Sure, yeah. Well, on the first side, I think we should talk about the fixed income, where we've kind of set things up to be, more short-term than we were in years past. So most of our funds that we've invested in on the mutual fund side have more of a short-term lean, whether the fund itself can go anywhere inside the fixed income or it is truly a short-term fund. The duration of those bond funds have been more short-term, 0 to 5 years, I would say. And we have a nice cross-section of solid performing funds that have done well over many years and many markets. And on that side of the table, we haven't increased our weighting, but that would be one place where we could be more defensive. Go back to John's comments about interest rates, though, and I don't think going into fixed income more heavily in, say, a balanced model is going to give us the more defensive nature that we want. I think maybe going to cash with some of the money would be a way to be more defensive than going into an overpriced bond market. So the one thing I think we could do is go to more cash or go to a mutual fund or an index ETF that's a money market type fund, and that would allow us to protect on the downside should we see a downward pressure market, something like we experienced in May of this year, something like we experienced last year about this time. On the equity side, we've kept out of emerging markets for now some time. We've decreased our risk and decreased our exposure to international as a whole, and we've kept our exposure in U.S. equities, which goes right in line with what John and Paul are thinking. We need to find managers that can find good stocks in this market. Paul mentioned he's bullish on dividend value. Well, our Neiman Large Cap fund is a dividend value fund. The AB Large Cap Growth is a solid growth fund that's been performing well. We've got some other areas that we've decreased our exposure and put that exposure into U.S. large caps. I think that in itself has helped us perform better and still decrease risk by finding quality managers. So really staying the course is where we're at until we see something happening, and not being reactive in a way, but being proactive by putting cash to work, by rebalancing, selling high and buying low. That's the way to invest our clients' money the right way, as opposed to selling low and buying high. So taking some of those principles into account and really staying the course with solid managers is what I think is going to keep us ahead of the curve should we see something happen in the first quarter of 2020.
Perfect. Thanks, Dan. And in addition to, kind of guiding the overall investment policy of the firm, you also have a couple of individual stock portfolios that you manage, separately managed account portfolios. one of which is really, I think, unique in that there's not a lot of other covered call strategies out there. And as a result, that stock portfolio, when you think stocks being aggressive, is actually in the same category as our balanced model from a risk standpoint. So maybe just, for a few minutes, talk about the covered call strategy that you operate, that individual separate account stock portfolio, and how those covered calls help to add additional income along with the dividends to an investor that might be an income investor looking for some cash flow from their portfolio.
Sure. I think the beginning starts with the screening process, and Paul mentioned it. I think all of us as stock managers have a disciplined and repeatable process. And so when it comes to the covered call strategy, which I've been running for 20 years, I have a very disciplined and repeatable process. I'm screening for stocks that pay a dividend and that have solid metrics when it comes to the screens that we're running. Low debt, a good dividend, meaning 2% or higher, and sometimes at the 2%, it's a little less than 2%. It's because the stock appreciated in value, and that's why the yield went down. A few other metrics like PE and price to earnings growth, as well as market cap. I've got to have large cap value stocks. I'm then going to buy a stock and sell a call out 3 to 6 months so I can capture a dividend. I still own the stock, and I'm going to get some premium back from selling that option out to 3 to 6 months. And I'm going to sit and wait. And most of the time, one of three things is going to happen. The first thing that's going to happen is the stock goes up and the stock gets sold and we make the money that we plan to make. The second one is the stock stays between our break even and the strike price of the option, in which case we can always sell another call after this call expires. And the third scenario is a scenario where the stock goes down. And I've got two choices there. I can hold the stock till it comes back up in price. I could buy some more of the stock, I guess, or I could just sell the stock and get out of it. And so the way the strategy has been run for the last 20 years really has been buy quality stocks, sell the options out, and then it's a wait and see approach. So you've taken the option premium in as some income. You take the dividends that you get from the stocks as income, and typically I hold anywhere from 10 to 20, even higher percentage in cash to look for those opportunities like Paul mentioned, where sometimes when the market's going up, you don't see a lot of opportunities, but then you get a correction, and all of a sudden you can put that cash to work. So for most of this year, while the portfolio has done well, it's held 15 to 25% cash at times. Stocks get sold. I don't see an opportunity to buy a new one right away, and I'm going to sit and wait and not put that cash to work into a stock just to be invested. I think that not being emotional with the stocks that we're holding, and at the same time finding good quality stocks that fit our screening process and using that disciplined and repeatable approach to buying stocks, selling the calls, and capturing the option premium as well as the dividend helps really, like you said, keep that portfolio in more of a low-risk environment than a regular stock portfolio that's maybe 100% invested all the time. And so that's kind of been the strategy, and it really works for the long term, and it also protects from the downside.
One of the things I'm hearing you say is patience is important, right? So, picking your spots, letting the market come to you, not trying to force things, I think is really an important takeaway from, the things you just talked about, and just, being very patient to not necessarily let that extra cash in the portfolio kind of burn a hole in your pocket, so to speak, but to wait and pick those opportunities. So oftentimes, we're waiting and looking forward. I know it sounds crazy to think, but we're looking oftentimes for a correction so that we could take advantage and reposition portfolios. So, John, I'm going to swing this back over to you. We've had that opportunity, last year in the fourth quarter, the market corrected 25%. It was a fast and furious correction and didn't give us a whole lot of time to capture as much of the stocks maybe as we would have liked before the rebound. But what are you looking for as far as an opportunity goes, or what kind of market level would you be looking to maybe put some cash to work as a part of the question? The second part of that question is, one of the catalysts that I see as a potential for an earnings catalyst would be future tax cuts, especially on the consumer side or the individual tax cut side. So if you could answer that two-part question for me, that would be terrific.
Sure. I'll kind of start with the second. And if we did get some kind of a tax cut, that would just reinforce the strongest factor in this bull market, which is the U.S. consumer. They would have more money in their pockets because right now they're kind of getting pretty fully spent, fully leveraged. It's people getting new jobs or increasing salary by moving from job to job that are able to expand their spending. But if everybody got a tax cut, that would help, and that would give the market a boost. But on the first question you had with regard to the pullback, it's difficult to say. My work tells me I'm watching the 2850 to 2900 level on the S&P 500, which would be about a 5% pullback. That's where I think we can move very quickly in a matter of days. And then I think if we can hold that level, that's probably, and it's stabilized there, it's probably your entry point. If there's enough information that starts building on itself, things I'm seeing that nobody wants to talk about, we have slowing CapEx spending by corporations. Cisco Systems came out with their earnings a couple of weeks ago, and while they did well for the quarter, they warned that 2020 was looking slower than 2019 because of their pipeline. And they said it's because CEOs around the world, which is who they sell into, the major corporations, are cautious right now, not knowing what's going on with worldwide economic growth due to the tariff situation. So if that's a prime signal that economy's slowing. You've got 3 months in a row with ISM, which is manufacturing index, below 50. That's serious when you get 3 months in a row. One off is nothing to worry about, but when you get 3 months in a row, and if that pattern continues, that's not a good pattern. So if these things keep mounting as they are, we could get more than a 5% pullback, maybe 10, and then and when you get these pullbacks, some stocks pull back more than others. The S&P may pull back 10 if you own an ETF in the S&P. That's great. It's easy to dictate, your in and out levels. But when you look at the broad market and when you have a portfolio with individual names, there's some that could drop 20% pretty quickly, and that's what we're looking for. We're looking to pick those off, even if the market's down 5 and something's down 20, but nothing's changed because it was a little more of a premium in it. That's what we're looking to pick off, and we'll play it by ear. But I think it's going to happen relatively quickly, Glenn, when it happens, and I think money will come back in.
Perfect. So that you mentioned trade, and that will take me back to you, Paul. Obviously the technology and semiconductor, very dependent upon China. You saw a lot of volatility in the first 3 days of this week. We've seen a couple % correction even. Just on some of the talks, I think President Trump came out and said, well, I'm in no rush, and potentially we're not going to get a deal done until after I'm reelected, which I think we all kind of agree is a possibility. But talk to me about where we're at, how big of an impact this supposed trade war. Certainly it's on everybody's mind. It's something you hear in the news constantly. I've heard a lot of clients mention that as a concern. What are your thoughts about where we're at with the the trade negotiations with China and how that might impact the markets in 2020?
It's really important, Glenn, for the technology sector, and particularly when you peel back the onion with the technology sector, the industries that are semiconductors and hardware oriented, because those companies have the closest bond with the Chinese and their supply chains. A lot of folks don't realize that we design all this stuff in Northern California and Silicon Valley, but rarely do we manufacture it there, right? It's not just the Chinese supply chain, it's the South Korean and the Taiwanese. And so every time the president makes a comment and gives an indication one way or the other with the status of these talks, you can see how they really have a magnified impact on my stocks, particularly those. So I still worry quite a bit about it. Do we have something in the phase one negotiations that reached an agreement? The problem with that is, I don't want to say it's much ado about nothing, but it actually doesn't solve the key problems with the accusation of theft of intellectual property by the Chinese of U.S. companies. And so if this lingers, and it indeed is not solved, if solved at all, until after the election in November of 2020, I'm a little bit worried, and here's why. One of the biggest keys to technology going forward is going to be the adaptation and build-out of 5G networks. And if we continue to delay with the negotiations the rollout of 5G networks, then we have a real precarious situation because the Chinese may come out ahead in that important technology if we linger too long. So I would love to see a deal wrapped up because it's really important for our technology superiority to be first and aggressive to 5G, and that is rolling out as we speak. It's not really a big phenomenon for 2020. It'll be a really big phenomenon for 2021. But, man, let's hope that it's resolved well before then, because if we come out the other side and the Chinese lead in 5G, we could be in some trouble, not just within semiconductors, but within the technology sector and even beyond.
Thank you, Paul. That sounds a lot like the 1960s race to the moon with Russia, right, with Sputnik and the rest of the deals. So hopefully we'll win the race.
Very similar.
Yeah, well, hopefully we'll win the 5G race. I've had confidence that we will, just like we won the race to dominate the new frontier in space. So thank you, Paul. I appreciate that. And that's going to really wrap up the call today, folks. We're a little bit long, but I wanted to mention a few upcoming events before we go. We have our in-person economic update that's going to be in our flagship office in Williamsville at 305 Spindrift. That will be February 10th. Our next client update or economic update call, it's open to more of the clients, I should mention that, is going to be March 5th. You can sign up for both of those through our website at iswealthmanagement.com. You can also find out all or watch all of the latest videos that we've posted, from Paul Meeks on CNBC to John Thur on ABC to Dan on Fox News and Fox Business. So go to our website again at iswealthmanagement.com, IS for Independent Solutions, wealthmanagement.com. If you're interested in speaking with any of our committee members or any of our portfolio managers, or just finding out more about Independent Solutions in general, you can also go to our website, or you can call us at the office at 716-568-8566. Again, area code 716-568-8566. Or again, go to our website at iswealthmanagement.com. You can also email me directly at gwiggle, Gwiggle, at iswealthmanagement.com. So thank you all again for joining us today. This concludes the fourth quarter 2019 Independent Solutions Economic Update and Market Commentary.